Welcome back to Investing Experts. I'm Rena Sherbel. Very happy to talk to Courage and Conviction Investing today on the show. Courage and Conviction runs the investing group Second Wind Capital. We talk about his nearly 50% returns in the first half of 2023, how he achieved that, how retail investors can be thinking about their portfolio allocation. We get into some deep dives around stocks like Advanced Emissions Solutions, RCM Technologies, how investors should smartly be thinking about stock picking, navigating the markets, and investing their time and energies into them. Hope you enjoy the conversation. Courage and Conviction Investing, who runs an investing group on Seeking Alpha called Second Wind Capital. And I myself just got my second win. So welcome to the show, Courage and Conviction Investing.
Hi, Raina. Thanks so much for having me. It's a pleasure to be here.
It's great to have you on. A longtime fan. I'm super happy to have you on the show. And I'm even happier because you just released your first half returns. And wow, if people are looking to past performance as any kind of future indicator, they would be wise to look at your returns. So I feel like that's a great place to start. We're July 20th, 2023. Do you want to really midpoint in the year, maybe a little bit past? Do you want to talk about what your performance is looking like and what your viewpoints on that are?
Yeah, sure. First half up about 46%. So I'm a small cap value special situations investor. Um, Deep fundamental work, speak with management teams, synthesize conference calls, try to figure out the sector, the ecosystem, where you are in the cycle, what normalized valuation you're paying for businesses, and then you try to overlay that with a catalyst, right? So that's kind of the formula. And so I'm 42, and I've been at this game for a long time. My dad bought me put $1,000 in Peter Lynch's Magellan fund when I was like 2. It did exceptionally well, and he was into the stock market, so that's where my interest was originated from. And I've just been obsessively following markets, reading. And it's just like it's an addiction. I guess there could be worse addictions, but I mean, I'm literally up at 4:30 in the morning, reading conference calls, talking to different friends about ideas. And the earnings seasons are incredibly fun. So you get every 4 times a year, you get to, for say 4 to 6 weeks, depending on the names that you're in, the sectors that you're in. It's just a mad dash. So it's from 4 a.m. to till 8, really. Some days if you could have multiple companies reporting, and you're trying to synthesize faster, you try to be up to speed faster, because you want to catch an inflection point. And especially in small caps where the depending how levered the balance sheets are, I don't do a lot with really levered businesses per se. I'd have to really know the business well, and depending on where you are in the cycle. If it's a commodity, that can be different if you're at an inflection point. But I try to stay away from leverage. But my point is that in small cap land, companies can literally move 30, 40, 50%, 100% in a week. And so you just don't have the luxury of say, oh, get to it in a couple of days. And that's what makes it so exciting. And the reason I love small caps is because there's just so much alpha. The structure of the market is such that the big buy side money, so pension funds, endowments, mutual funds, insurance companies, they can't buy enough of these equities that say sub a couple billion, and especially sub 500 million, that they just can't size up a position, even if a company doubles, to make it worth their time and efforts. And it's just too hard to get in and out. So you have tremendous pricing inefficiencies. And with that comes a lot of volatility. But if you really know your names, if you know your companies, and within the context of a portfolio, this is just a great hunting ground. And I don't know why more people aren't into this sector. My guess would be it's really a function they can't stomach the drawdowns because literally sentiment or a negative report or downgrade, a company can move 20%. Nothing is fundamentally changed about the business. So I run a pretty concentrated portfolio. I have about 15 names right now. The vast majority of the capital though is probably in, say, the top 5 to 7 to 8, where the latter pieces are like 2 to 3% sized. I try not to go above 15%. My conviction has to be very high to get to 15%, but I do regularly have like 1 or 2 15% names, usually one, and then I'll have a lot of like 8 to 10 to 12% size names. And so I've been at this so long, the key is really this game's about slugging percentage. So hitting for extra bases. And within the context of a portfolio, if you have 1 or 2 really good winners, the returns add up, very quickly. And so this year, it's just been, if you survive. So January is fantastic. Had a big January effect portfolio that it put together. Got lucky that did really well. The Russell 2000 ripped in January, and then it got really tricky February and March with the banking crisis, regional banks, Silicon Valley, First Republic. The whole regional bank index was just got destroyed. Fears about the value of the securities not mark to market, like huge losses because interest rates had gone up so quickly, and just a lot of fear. So then small caps got completely dinged. I think the Russell swung from like up 10 at the peak, maybe a little north of that. Actually, it was probably up maybe 12, and then I think it went to either flat or negative. And so you just have to weather those drawdowns and know your names and have conviction in those names. But when you get those big drawdowns, that's really where you can make the money, is sizing up names that you really, really know well, where just things get completely disconnected, and you just take advantage of that. And so really the returns were driven by taking advantage of irrational, illogical sell-offs. And I can give you a specific example I think that may be helpful just to explain my thought process, or I don't know if that would be.
Yeah, please do.
So this is company RCM Technology, ticker's RCMT. I originally wrote it up behind the paywall for my investing group service March 31st of 2022. The stock was just under 10. And then by June, I think 6th or 8th, the stock hit 29. It was a COVID winter, kind of pull forward. The earnings ramped dramatically. And then I kind of lost sight of it because it moved so quickly. I didn't capture all of that move, but I did certainly did capture some of those gains. And I just kind of had on my back burner because I follow literally 300 companies just on my radar. I'm literally, and the Seeking Alpha, by the way, is incredible tools for following news, press releases. So I literally follow 300 tickers, and every morning I'm checking every 15 minutes press releases. Are there new press releases? Because I don't want to miss anything. And this SA news team does an incredible job with finding really good pieces of news and information. A lot of times well ahead of like a Wall Street Journal or a Bloomberg or maybe Financial Times.
Agreed.
So anyway, just to get back to RCM, get back to RCMT. So they had pretty good numbers Q4, and I said, okay, I'm gonna put this back on a 10% position at 13 and a quarter. And within 2 weeks, the thing dropped to 10, 22 in my face. So I'm scratching my head, and I got the CFO on the phone. A lot of times, if you write a good note and you explain who you are, the management team, especially the CFOs, are happy to talk with you, and he certainly was. So I had a really good conversation with the CFO. He was in Ireland on his way to Germany for a business venture. I was really impressed with him. And then I'm scratching my head. I'm saying, all right, the stock's trading at 5 times earnings at 10. Balance sheet's fine. The CEO, Brad Veazey, owned 1.5 million shares. The share count was 12 million, but they've been aggressively buying back the stock. And they had this huge tailwind because of the biggest K through 12 school staff nursing business. And so post COVID, there have been a lot of behavioral issues with students falling behind, having difficulty adjusting. And so they have these really specialized nurses that are really credentialed and that are a great resource for school systems to help children having issues. So I said, okay, the balance sheet's fine, trading at 5 times earnings. Management owns a ton of stock. They're buying back stock aggressively. The conference calls read incredibly well. The outlook is really strong. What am I missing? And I wasn't missing anything. So I bought more. So I took it to 15%, and I was literally singing from the mountaintops to my group. Every day, that was a kumbaya. I don't want to talk about anything else. I want to talk about RCMT. All right. I want you to get to 15%. If you have the if that fits your risk parameters and it makes sense for you and you have the dry powder, you have to get in this thing. And so sure enough, subsequent to the two events happened, and management ended up buying back a lot of stock. They had a good Q1, it was ahead of consensus, gave a strong outlook, and then they actually bought a nice block of stock from some institutional holder. So once that got cleaned up and the supply and demand overhang was alleviated, the market said, you know what? This is exactly what we want to bet on. We want smart management teams. We want a good outlook, good balance sheet that are buying back stock. And when the stock got to 29, Brad, I think, sold 100,000 out of 1.5 million shares. So 1.6 million shares times 30, that's a lot of money. And so for him to have that much confidence, not to take more than that off, that spoke volumes to me. So I'm largely out of it because the stock hit 20 and my price target was 20. So I don't want to get overly cute when the stock goes from 12 to 20 in 3 months. And I haven't even seen the Q2 print. And seasonally, it's more of a second half business because the schools aren't in session in the summer. But that is one example of the immense amount of alpha that is available if you're willing to turn over a lot of rocks, if you're willing to pick up the phone and talk to management, if you're willing to synthesize the conference calls, if you're willing to think about what am I paying for this business, if you're willing to take a step back and say, what is the outlook for this business? Is it going to be around in 5 years? What's the competitive advantage? What's the ecosystem? What's normalized EBITDA? Think about all those things. And so, again, the market cap was just too small. Institutions don't care. Very limited sell side coverage. And not to be overly negative, but I'm on the call and I had written pieces about how because if you looked at the updated Q, you could see the change in share count, so you could see how aggressively they were buying back the stock. But on the conference call, the sell side's surprised that they bought back that much stock. If you simply looked at the difference between the K and the Q, you could have worked out the math. Because again, the sell side's covering 25 names. They're not doing any secondary. There's no banking relationships on the debt side, so they cover it, but it's not the top of their list because they have other situations they're involved in. And again, if it's not banking, it's not at the forefront of their minds. That said, there are some very good sell-siders. It's just really nuanced. It depends on the company, it depends on the industry, their experience, and whatnot. So I don't want to just broadly say the sell side isn't good, but I think they're just spread so thinly that they're not at the forefront per se to catch some of these inflection points. And that's where the serious money gets made, is the inflection points.
Mm-hmm. I think what you're describing is a really nice example of something that you talked about in this article where you wrote about your first half returns, and you said something that time allocation is one of the most important things that an investor can have. I would add probably in life and not just in investing. Show me somebody that knows how to allocate their time wisely, and I will probably show you a successful person. When you're talking about uncovering all these rocks and doing all this due diligence, do you find that that's unique to, not unique, but it's especially true for small caps as opposed to maybe mega caps or large caps or more well covered stocks where the news is really out there in a more public way? And B, how long was the process before you honed the strategy that you're using today?
Yeah, I would have completely agreed. Bandwidth is so important, and people that are the best allocators of bandwidth, balancing work, family, health, other commitments, friendships, trying to enhance yourself educationally, maybe doing some volunteer work. It makes you more well-rounded. But there's certainly, it's like the Pareto 80/20, which I'm not great at getting enough rest because I'm up too early. But you want to be smart, strategic about how you allocate your time. And I don't run any quant screens. It's very much it's an art. It's just reading a lot of news, and it becomes like a spidey sense because I've been at this for so long that you learn through your mistakes. Like, your mistakes are the greatest teacher. And what's so unique about investing is if you strike out and you get hit in the slump, then you have to get a step back and get really cerebral and say, okay, what am I doing wrong? Why isn't this working? How can I learn from this? How can I apply this differently? And how's this going to make me a better investor? And that's what's so unique about this business. But I've also learned that um, you got to kind of be grounded and not get too swept up in the euphoria. Like 2020 was just fantastic. But I, not to get too far off tangent, but in Thanksgiving at 21, when there was the Omicron wave of COVID, that was like the market ringing the bell at the top. And I was definitely really late because had put up such monster returns in 2020, and that was up like 80% first three months of 21. And I kind of got little took my eye off the ball, and I got beat up really. I gave back 25% in Q4. And I totally missed I totally underappreciated the inflation, and I totally underappreciated how high the Fed would go, and I totally underappreciated how that would totally change the narrative. I mean, I could obviously understand the net present value and the discount rates and access to capital and all that stuff, but I was definitely caught flat-footed in 22, and I had a fight to be up like 5%, and it was a complete dogfight. How am I going to grind every day to keep my head above water? How am I going to hit singles, bunt singles, sacrifice the runner, hit a sack fly, field well? Like, I love the
I know.
baseball
I hope people following
analogy.
along
Yeah,
are baseball fans.
yeah, yeah. So I just think the biggest thing is, like, I got so up in 20 because I run money for my parents, and my mother is extremely risk averse. And I was up 93% in 2020, but on the actual managed capital, it's probably up 400% if you actually look at like the available capital. And so it goes to your head, right? You start thinking you can't miss, and you start missing stuff, and you get kind of sloppy. And that was a really important lesson. And so through the school of hard knocks, and you have to change strategy and change course. But I will say one of the biggest things that I've learned is And I love Buffett. Buffett's by far my favorite. I think he's the greatest of all time. Malcolm Gladwell's talked about how uh, genius and success is really, you need to think about longevity, right? You just can't have a great stretch for like 5 years. It's the people that can do it for the duration. And Buffett's record is just incredible. But management teams are so important in small caps. Do they have skin in the game? Are they competent? Do they work hard? Are they aware of things? And they create the value oftentimes, and they can destroy value so quickly. And that's, I would say, as part of my evolution, and I'm literally learning every day. If you're intellectually curious, you want to get better every single day, iterate every day, every month, every year, and then hopefully that knowledge compounds, that wisdom compounds. And then if you get a little bit off course, you got to course correct. But I would say the biggest thing that I've learned is how good is management, and that's an art. It's really a subjective evaluation, and you have to speak with them, and you have to synthesize the conference calls and say, what can they control and how honest are they about what they said they were going to do and then what they did. When they start talking about the weather and making up all these excuses, that's not a good sign. When they don't own a lot of stock, that's not a good sign, right? I want to invest with entrepreneurial people that have skin in the game, that want to get paid. Like you think about John Malone, the billionaire, he hired a lot of brilliant people and he paid them mostly options, right? Out of the money, but long duration options, right? And he said, if you do well, you will get incredibly wealthy. If you don't, you'll make nothing, and the relationship will end. But I only want to hire people that have the belief in themselves, the incentive, the ambition, the drive to want to go out and create something and to want to trailblaze and to do something different, to disrupt, to build an organization that's better, that has better margins, and that's gonna earn their cost of capital. Constantly learning, but that's one of the big things that I've learned the hard way. Half the management teams are mediocre at best. There are the few exceptions, and those are the people that you really want to invest with. So like, to give you an example, Travel Centers of America. I originally bought it $41 in September 1st, 2021. Okay. So you have Pilot and you have Love. So these are mostly these are truck stops that are diesel fueled. They mostly sell diesel. And then the business chronically underperformed under, like, Love's and Pilot, they own the Browns, right? They're billionaires, and Love's is incredibly successful. And so they brought in a new CEO. I think it was John Pertichik. I hope I didn't say his name wrong, but he came from the hospitality business, okay, hotel business. And I said, okay, they put up their first good quarter in like August of like 21. And I said, whoa. And I went back and I read every one of his conference calls. I synthesized, I read them twice. I said, oh my God, this guy's incredible. And from the time he started, EBITDA was like sub 200 million. It was like maybe 180 million. And then by the time BP bought them out for $86 in Feb of 23, so not that long, the EBITDA was like almost 400 million. But step by step, he got diesel margins from, say, like 12 or 13 cents to like 18 or 20 cents. So you're talking billions of dollars. Like the difference between making 14 cents and 18 cents, we're talking serious money. They had the best repair fleet in the business, right? So he realized that he had to get better techs. He had to pay the techs better. He had to staff them, because that was a key point of differentiation. He fixed the parking lots. He painted. He made the bathrooms clean. He made the showers clean, so people wanted to actually stay there overnight. And then when you stay there, you'd maybe buy something in the restaurant. You buy something in the convenience store, because that piece of the business had 50% margins, right? And then he worked on the small fleet business, which was underutilized. Then he ramped up the franchise business, underutilized, very profitable, right? It's like 250 to 400 million in EBITDA. He bought some strategic pieces to complete the portfolio, and they had like 280 sites, and they owned 50. They owned the land free and clear. So I'm like, okay, the land itself, and the debt was like 8%. It was baby bonds, but it was expensive to call it. So he's like, I'm too busy trying to turn on the business to worry about calling this debt at like 104. And so, but methodically, step by step by step, this guy brought in the people, and he literally did it. He turned EBITDA from 180 to 400. I went from 41 to 86. And they had, and I was like scratching my head. So during that ride, the stock went from 41, hit 64, wasn't a seller, came in to like, I don't know, I think it got as low as like 33. And I'm like scratching my head. I bought more. Like, this is nuts. And he just created incredible value. But there was a huge margin of safety because you owned 50 of the sites, and travel center sites are like 20 acres. So you have the whole EV piece of it, but we're talking the land and the sites. So I'm saying, like, all right, I'm buying this company at 33 at a negative enterprise value. And the rents were like 10-year fixed. So there was, it was just like, it was one of the best value situations that I've ever seen. Obviously did really well with it, but in retrospect, it should have been my number one position. And it was like number 5. But that is a really good example of how a good management team creates value. And the thing is a lot of people look in the rearview mirror that the company's terrible, the management's terrible. It's like, no, guys, like they switched. The guy totally cleaned house. But the perceptions, and so by the time the street figures it out, the thing's getting bought out. Like, oh, how did I miss that? Because well, you weren't in the weeds. So I mean that's a good example. But most of my returns have been really high conviction bets. I've had some strikeouts too. I've definitely had some strikeouts. Again, it's about slugging percentage. Let's keep it honest. I've had some crash and burns. Lottery.com, which was complete fraud. They published a 10K that turned to be complete fiction. Like, I've never seen in the US like a 10K where you say where the cash is wrong. Like, the cash was like blatantly wrong, and they report adjusted EBITDA and it didn't match the cash. I was like, what the heck am I missing? But the CEO was an incredible salesman. But had I done better diligence, like the team was a bunch of jokers. Like, they didn't have the resumes. They went to the Silicon Valley gold rush. They did well, and they got some equity, and all of a sudden these guys are management teams, but they weren't seasoned. And it was a big oversight on that one. I took a pretty big loss there. But it's par for the course. You dust yourself off. What are you going to learn from it? You get back on the horse, right? You don't give up and say, oh, I can't do it. It's all right. I made some mistakes. I'm not going to do that again. And I've made others too. So it's to hit for high slugging percentage, you're gonna make mistakes, and you're gonna have some strikeouts, and it's just kind of par for the course. But within the context of a portfolio, again, if you're not getting above 15%, 10%, if you have something, I mean, it's bad. If you have a 10% name and you lose 80%, it hurts. Or like a 5% name, you lose 80%, it hurts. But if you're hitting for multi-baggers or 100% on some of the other winners, then those kind of offset themselves. So that's just kind of the way the math works. But I think a lot of people shy away from small caps just because the drawdowns are intense. They just can't stomach it. And if you want to make the returns, you got to go where it's you got to traverse the rugged terrain.
It's pretty clear to me how you got the name Courage and Conviction Investing. Is Second Wind Capital, is that kind of dusting yourself off and being able to come back with a second wind for being dissuaded from a thesis? Or can you explain where the second wind comes from?
Yeah, so all right, so just quick background. So I went to UMass Amherst, I majored in finance. I was so passionate about markets. I wanted to land in Boston as an equity analyst, a junior analyst. And my senior year at UMass, there was a guy, John Mark Berteau, that came to visit. He was a UMass music major. And this guy, Rena, was the most incandescently bright guy I've ever met. He was a portfolio manager for Wellington, ran 4 billion. And he handed out his card, and I just kept calling this guy. And he's like, I love your persistence. I love your passion. This guy's was a partner at Wellington, right? This is the most elite firm besides Capital Group on the mutual fund world. Wellington and Capital Group are like, Templeton. Those are like the cream of the crop. And so here's a guy that has incredible responsibilities, international equities. And he said, you know what, I'm going to work with you because you have the passion, and we're going to trade emails because your writing has to get better. Your writing's not really good. And if you want to make it in this business, your writing has to get much better. And so for like a year and a half, because I was kind of, I couldn't get a seat in Boston, and he worked with me, and I've been lucky because I've had some great mentors. I have another mentor that runs a $600 million family office, and he was exceptionally helpful, and we're friends. And so I've been lucky with that. But in the equity world, especially in Boston, maybe more so, it's less so in New York. New York's more of a meritocracy. But for my wife was 2 years younger, and I didn't want to move to New York. I had an opportunity at Goldman Sachs, but on the operational side. And so it was literally kind of being in the wilderness and like trying to pursue the dream, and you couldn't really do it, and kind of hope to keep the hope alive. And I forget when I discovered Seeking Alpha, but like I think of like a singer songwriter, and like you're really good and you're good, but like there are thousands of people that are really good, and you go to Nashville and you wait tables, and you kind of wait for your break, and it doesn't happen. So you got to go back and say, all right, well, that didn't work. So what are you gonna do? You gotta reboot, and you gotta still live while you're doing that. So Seeking Alpha was such an oasis for me, because I had all this intellectual curiosity, I had all these ideas, and I wasn't quite ready yet to good enough to land. I interviewed at Fidelity and all these places, and I just couldn't land. And so it was my sanctuary. Like I would moonlight at night, and I'd write these theses, and it was a platform where I could share my ideas, and I could put that out there. And so it really helped my evolution. But I did work in investment grade bonds for 5 years, a $50 billion portfolio. I worked with analysts and PMs, and it was a really good experience. But it was a great pathway to make a great living, vacation, but it just didn't blow my hair back because it's investment grade bonds. And so like, it's fine. And if you want to make a living and support your family, it's great. It's just, it wasn't enough of an intellectual challenge for me. Talk about like a journeyman, like to switch like sports metaphors, like you love the journeyman that like is 45 and like loses his tour card, like has some issues, and like still pursuing the dream, still on the tour, keeps his card, and then he breaks through at 45 and he wins. And maybe it's the Hartford Open, or it's like I don't know, some lesser tournament, the John Deere Classic, or not a premier tournament per se, but that stick to itness, that persistence, that passion that says, I am going to put 4 good rounds together, and I'm going to do it. I know I can do it. I've never lived up to that potential, but I'm going to do it. And they do it at 45. I mean, it's easy to see in sports because this is like a pure meritocracy. But the second win capital it's an ode to the wanderers that, you failed your first time, and you come back and you try to do it again.
Yeah, so much of what you just said resonates really strongly with me, from the writing, learning to become a better writer. I think people that don't have a deep understanding of the investment world don't know that about the investing world. I spent a lot of time covering hedge fund letters in my time at Seeking Alpha, and I was completely blown away by the level of writing and the nuance of thought. And you use this turn of phrase, incandescently bright. That's a beautiful turn of phrase. And so many people, not so many, but there's a handful of people that strike me as that. And also how you describe kind of the unique alpha, I think that Seeking Alpha affords people. There's just people that I never, ever would have been able to read. And I think there's people that would have never thought about writing if a platform like this didn't exist. So I appreciate that. And also just on a really personal level, a lot of what you said just resonated very strongly with me. I'm curious, you mentioned towards the beginning of our conversation, this notion that some of your investing thesis was thrown off by the more macro elements of the picture, the Fed. And you don't spend a lot. You wrote this article about Peter Lynch saying if you spend 13 minutes a year on economics, you've wasted 10 of those minutes. You don't spend a lot of time on the macro picture. And a lot of people we talk to on the show do. I'm curious why you don't, and how you would, I guess, caution the average retail investor about the macro picture in addition to whatever stocks they're covering.
So if you take a step back, if you've read David McCullough, the great historian, he died like a couple of years ago, but is just a brilliant writer and thinker. The American experience, the experiment is so unique. It's just such a dynamic country, and the probability of beating the British was very unlikely, and you had the right people in the right places, and you had luck, and you had Washington, and you had different events, and France comes into it, and they just outlasted the British because they had the heart to be the underdog. You just don't bet against America. Okay, if you look at history, if you read Buffett, it's a incredibly dynamic people. They're very smart, ambitious people. We have the best system. You could argue that, but I think it is. And it's a pure meritocracy, and really bright people from all over the world come to our universities. That's what kind of makes America so unique. They have the college and graduate level and the PhD programs, like Google. They're from Stanford grad school, and there were a number of those success stories, right? So this is literally the streets are paved in gold in America, and that's my view. And I had a great mentor, Rodney Thomas, that I met on the golf course in high school, and we became great friends. He died at 47 of diabetes, just the most charismatic, great guy, my first mentor in business. And he said, you just don't bet against America. And it hasn't paid to bet against America. And I get all the great arguments about how interest rates have come down and the debt's done this and the growth rate's on us high and all this other stuff. But the American ingenuity and just the system where if you come up with a great idea, you will find capital, you will find pools of capital, and you can create these companies out of garages, like the Steve Jobses, the dynamism of the ecosystems, like the clustering of Austin, of Silicon Valley, of before it was Rochester with like Eastman Kodak and Xerox and Polaroid, and just been countless companies and different waves and different industries. It's just not a good bet. So it's incredibly complex, and you have these people that are PhDs from Chicago. It's always the same five schools, right? Chicago or Harvard or Princeton, and it's the clubbiest of clubs. And these are like 165 IQs, and they get paid ridiculous amounts of money, and they can't predict the market, right? So if a PhD from Chicago that's been working at Goldman for 20 years can't predict the market, why would I think that I could predict the market? My time, going back to bandwidth, is not, I can't add any value. I don't have any edge trying to think about the market. And so, yes, I got caught flat-footed. Yes, I underestimated the Fed. Yes, I made some allocation mistakes, but that's once every 10 years. And so the mistake that I made, just to take a step back, is I had my parents 100% in cash in 07, right? And so we were early. The market crashed in 08 and 09, right? And so I felt like a genius. The S&P goes from, I don't know, I think 1400 to like 666 or 661 or whatever the lows were, right? Okay, great. We sidestepped it, but then I was too pessimistic. And so then the market ripped in 09. It absolutely ripped. I was in B school at Babson at night, and I did a great work on Chipotle Grill, and I built this model that was really good. And like, I'm like, the stock's incredible. I forget where the stock was, and I'm like, no, I can't buy it. I'm negative in the market. The macro is too challenging, and all these different superficial things, right? Well, Chipotle is up like, I don't know, 20x something from there. And so, yeah, okay, great. I sidestepped it, but then I missed the huge leg up, and I missed the 3, 4, 5, 6, 10 baggers, right? So I can't add any value doing that. Yeah, look, the market ripped from 19, 20, 21. So coming into 22, valuations were very high. There were definitely threats in the horizon, and a lot of people made a lot of money short. But again, I'm a value investor, and so I'm buying businesses for like 4 to 8 times EV to EBITDA, what I think is normalized EV to EBITDA. So I'm not playing whiz bang tech, trading at like 40 times sales and say, I think I should trade at 45 times sales or 20 times sales. I should trade at 30. Like, that's not the game that I play. So I don't really care about the macro per se, because I can't predict it. It doesn't really add any value. And I think what really hurts a lot of retail investors are they think they can jump in and out of it and they can time it, and they don't have an open mind to a great opportunity. I mean, you have 3,000 companies publicly traded, maybe north of that, but in the Russell 3000, like I hate to, I don't really like Kramer, but there's a bull market somewhere and there are opportunities. And so whether it's, if certain things are out of favor, maybe energy will do well, or commodities will do well, or ESG will do well, and so I don't see any value in doing that. And I don't see any value in trading futures contracts and leverage and doing all this crazy stuff. Like, you don't need to get that fancy and take that kind of risk, in my view. Where if you do old school bottoms up fundamental analysis and you pay the right prices for businesses and you're reasonably good at it, you're probably going to outperform the market. And so, notwithstanding like an Armageddon scenario, or God forbid, some like nuclear event or something, but at that point, it's not even going to matter because the world's not going to exist. So it doesn't really matter what your stock account's worth. So, um, I don't see any value in it, notwithstanding once out of 10 years, where you have a event like the housing crisis in '08, which I did see. I saw it 2 years ahead, but then, like I said, then I missed the huge leg up from '09, and even in like 2011, like the banks, B of A, and I mean, I specifically remember calling my dad. We bought Wells Fargo preferreds at like, I don't know, 11. The par value is 25, and these were the J's, the Wachovia, I think the J's, so 8% coupon. And then I remember calling about B of A, and they were 20 cents on the dollar. And he's like, I don't know, like, you just had me in the equity and we lost like 50%. And I was like, I know, but we're buying the preferreds at like 20 cents and if B of A makes it. And the sentiment was so fever pitch negative that the world was going to end. And sure enough, lo and behold, David Tepper steps in. He's the only buyer of B of A and Citi preferreds. And he swooped in and made billions. And he said some days when he was buying this at like the pinnacle of fear, it was like in Feb of like '09, he was the only one buying it. It's like, how many of these you want? And when I was on the investment grade bonds, I had a front row seat to the financial crisis because I did the research, but we also did some trading. And I remember talking to Goldman, talking to Lehman, talking to all these places, and like there was no bid for GE Capital paper, the finance. I'm talking the debt. I'm not talking the equity. It's like no bid. I just don't see any value in the macro. Once out of 10 years, it makes sense, but there are all these great companies, and I think you can get, if you just focus on businesses and paying the right prices and getting the right management teams, I think over the course of a career, you're going to generate vastly superior returns to people that think they can predict the unpredictable.
To this point, you wrote this article about commodity super cycles and this prediction you made when commodity stocks were on fire in 2022. Is that something that you're going to continue to pay attention to?
All right, so and this is like the humbleness and like how like I should be worth like $25 million because I've had so many stocks that have gone up 10, 20, 30, 40 times, but I never could quite get the timing right. So let me just take a quick step back. So when I launched Second Wind Capital, um, my top three ideas were Kirkland's, the home furniture store, and I really liked the CEO, and they refinanced the debt. We bought it at 175. I was out at 12. It hit 34. And then we bought Signet at 9 and it hit 113, but I was out too soon. That's partly because of my investment committee and my parents that were up 100%. They want to sell. But the third stock was a company, AMR, Alpha Metallurgical Coal. They changed their ticker. I think it was Contura back then. And then a natural gas company ended up taking that ticker on the name change. But we were in this, speaking of commodities, we were in this stock at 5. We had 4,000 shares. I didn't have as much capital back then. The thing went to like 4 in our face or something, and for whatever reason, I had to sell it. I had spoken with the IR guy. I was on the calls. I remember like the debt analyst. They had 600 million of debt. The equity was like 100 million. Lo and behold, there was this massive super cycle in met coal, and they were the biggest metallurgical coal company. It was a post bank reorg, so a lot of the debt had gone away, and they were producing like 10 or 11 million metric tons of, or I think that's actually probably short tons of met coal, and their cost structure wasn't bad. But the equity was so low because you were at the trough of the cycle, so prices were bad. It would kind of like break even. Can they cover the debt? Well, met coal goes parabolic, and this thing goes from 5 to 180. And I missed the whole thing. I was in it, had the thesis, spoke with the management, kind of forced to sell because I had to pick one horse. I picked Kirkland's. We did extremely well with Kirkland's, but if you get the timing right, you can make ungodly amounts of money in commodities. I did a lot of good work on the free site on Antero and Range Resources. I was in touch with Range Resources, and I think I wrote a piece about Antero at like $1. And I was in huge at like 2. And so when the stock goes from 2, like probably started buying at 4. And I bought some at 3, and I loaded up at 2, and then it's like, all right, it's 70 cents in your face. And I get a call like, why do we have so much in this thing? Is that we're down like, you've like tripled down, and now the stock's 75 cents. I said, they're gonna make it. Here, it'll be fine. But you're so mentally exhausted at that point, and when it's not your capital, when you have a drawdown like that. And then, so I think at 5 we were out. Well, lo and behold, the stock goes to 48. We were buying Range Resource bonds, like 2-year paper, like 70 cents. And they were like the low cost producer in the Marcellus. Balance sheet was fine. The bank debt got reaffirmed, and the freaking sell side was like putting out sell notes in the equity at like 3. I'm talking to management saying, your bank debt just got reaffirmed. Like, yeah. I'm like, okay. And you have the lowest cash cost structure in the industry. You own Great Rock. They made a bad acquisition, the Haynesville, that dinged credibility. But I was like, these bonds are money good, right? Like, what am I missing? They're like, yeah, we're buying them too in our PA. But I said, okay. And so Range absolutely ripped, but I didn't fully take advantage of it. And again, like AMR, thing goes from 5 to 180. That's a 36 bagger. You don't have to have a lot of money in a 36 bagger, but you got to let those winners run. So you can make a ton of money in commodities, but you have to get the cycle right. And so if you buy these things at trough earnings, they look very, very expensive. They have no earnings. But if they're a low cost producer and they own good assets and they can survive the cycle, the returns are incredible. But what I kind of noticed then was just a sentiment observation. I was seeing people that were like writing on technology stocks that were like covering commodities. I'm like, okay, this person's a tech writer, and now they've given up tech and they're writing in commodities, and like everyone was bullish. There's a company, UAN, which I wrote up at 27. It's a fertilizer company. They make ammonia, which is used in fertilizer, and natural gas is such a big piece of that. And ag was doing really well, and so to enhance the corn crop, they would do this, and the market just got really tight, and it was like a complete super cycle. But I think I was out at like 80. But there was the guy publicist that did a great piece, and he's a smart guy. I mean, don't get me wrong, but it was like a cult following. There's like there's like 20,000 comments on this article, and I'm like, everyone says, 300. I'm like, all right, we bought it at 27. And it's a commodity business, and it's not even, the assets aren't even that good. There's tons of competition. You got overseas competition, and you got lucky because of the Ukraine war that spiked natural gas prices. So 30% of natural gas goes into the input to make this stuff. So you had all the like this, and then there was a drought in Brazil, and commodity prices were good. So it was like literally this perfect storm. But it's like, all right, wait a second. I was in at 27. I was out at 80. And people are like betting their life savings on it at 180. I'm like, this doesn't make any sense. So it was as much a valuation, but it really was a sentiment and just kind of the art of, in the timing was a little bit lucky that everyone was in the boat. So if everyone's already in the stock, there's no one left to buy it. And then lo and behold, the cycle changes and these things get cut in half, or they go down 80%. What I see a lot of, which is kind of dangerous, we've talked about the macro, which I think is really dangerous, because you miss the upside, and it's just tough to do that. But it's really dangerous to have like all your money in commodities. Like I've come across way too many people that are just in energy or just in commodities, and like, okay, fine, if you don't have a 20% or 25% allocation, or really you know the space exceptionally well, maybe you want to have, I don't know, 35, 40, but you can't be 100% in commodities. It's just not how you do it. I think people just get so swept on the euphoria, the recency bias, that they don't get, that these are fragmented businesses that don't have any meaningful market share, and you're subject to the supply and demand. If either the demand comes on, or demand abates or gets anemic because of the macro or various factors, the supply comes on. Well, guess what? You're buying these things at peak earnings. I mean, look at, totally switching gears, and Jay Mitz is a really sharp guy. He's done very well. I'm a fan. But if, like, he was really early in Zim. He bought it, like, I don't know, at the IPO. Stock rips, it pays all these dividends. But a lot of people, if you didn't get out, then the stock, even if you include all the dividends, the stock still got crushed. And it's like, okay, great. If you got it early, you did great, but you're really late. Cinderella's going to turn into a pumpkin. Whereas if you're buying different types of businesses that have a moat, they have different industries, there's definitely cyclicality, structural situations, but commodities are so boom and bust. And if you don't know the patsy at the table, you can get run over. I think that can be a big blind spot with a lot of people, unfortunately. I mean, look at Cathie Wood, who's had all this success, and she made an incredible call on Tesla. It was just an incredible call, and she held it, and whatever went up 20x or whatever it went up, and she attracted all this capital, but then she had no place to put it and was making really bad investments, trading 20, 30 times sales. I think she had 30 billion at the pinnacle. So if you were in early, you did great, but most of the money that got invested, people net lost a lot of money because they chased crazes, they chased trends. And I don't blame her. That's her tune. She has to sing it. People paid a lot of money to go to the concert, like a Taylor Swift concert, and you have to sing that music. You can't say, "Oh, I'm Cathie Wood, and I'm going to start talking about REITs." That's not why you signed up for her. You want whiz bang tech. You want to fly in spaceships or whatever the heck she's invested in.
We want our favorites. I like that analogy. Courage and conviction investing. I really enjoyed this conversation. I think truly a lot of unique food for thought here. And I think also just a lot of compelling advice for investors. I really appreciate you coming on. Anything that you want to share with listeners before we go?
Yeah, no, I appreciate it. You want me to share my best top idea?
For sure.
Yeah, so advanced emission solutions. I've been on this trail for a long time, and in this business, you have to know when you're wrong. And I don't think I'm wrong. And I wrote a recent piece where I've tripled down, but I've done a lot more work on this company, and I'm behind the scenes. I've talked to a expert through a Wall Street friend. He hired an expert. We had a conversation for an hour. There's a lot of great stuff going on here. So just high level, this company is in the environmental space. So they make powder activated carbon, which is used to take out the toxins in coal-fired plants, and coal-fired plants are kind of going away. They do have some industrial and soil side, but they're in the middle of upgrading their plant. So they have this $400 million plant that they bought from private equity because private equity in 2009 made an incorrect calculation that coal-fired generation would stay at like 50%, and now it's like 20%. So they bought this asset that cost $400 million for $80 million through Apollo. It was a private equity firm. And the capacity utilization was really low, and they had all these bad legacy contracts and yada, yada, yada. And they had this great tax credit business with Goldman Sachs, and that sunset, and that made a lot of cash flow. So the company had a lot of cash, and they announced a strategic review, and I thought that they were going to sell it because you had one asset, you had all this cash, you had like $5 in cash, and you had this good asset. And so I thought, and I invested in it, and I wrote on it, and I thought this thing was going to get taken out at 8. And after 15 months, lo and behold, they did a merger with this company ARC, which is really interesting. Founded by Julian McIntyre. This is a serial entrepreneur that's been extraordinarily successful. You have a couple of Goldman Sachs partners, but the market hated it because everyone was in this for a deal. And the stock crashed, right? It crashed from like 6 to like got as low as like $1.20 recently. But because they have all this cash, and because they bought ARC, they have a 30-year supply of bituminous coal, which is the big feedstock you need to make this next generation product, which is granular activated carbon. And they're in the process of upgrading their plant to get to 60 million pounds of granular activated carbon. So the nameplate is 150, but you lose some of that to go to GAC. Long and the short of it is they have most of the money on the balance sheet to do it. The average selling price is much higher, but I'm going to be working on a piece, but just as a little preview, big EPA policy changes in flight that were published in March of 2023. Okay. And no one's connected these dots. And I've read the policy paper. And so this is called PFAS, which is the forever chemicals. And 3M just paid $10 billion to settle this. The EPA is going from 70 parts per trillion to 4 parts per trillion. I don't want to give away the whole plot here, but this policy is in motion. There's bipartisan support. It's going to happen. And so they're going to have 60 million pounds of granular activated carbon, which in the EPA report is the optimal way to treat these PFAS chemicals. Okay, so you have a huge catalyst, a new CEO that got announced this week that just bought $2 million worth of the stock, and he took a $50,000 salary. This guy's extraordinarily wealthy. So for him to take on day one, puts up, and above the market puts up $1.8 million, and he want to get paid in equity at $3. So I would argue this guy's in this for 10. Now, whether or not they can execute and do it, who knows? And there's always risk, but no one has even connected the dot on the EPA PFAS, where they're going with GAC, and the equity 70 million. So it's by far my biggest position, and I think it's wildly undervalued. That said, there's certainly risk. You do have to successfully upgrade the Red River plant to be able to process on the front end side to make the granular activated carbon. But the market has not worked out this PFAS angle. And like, if you just kind of like do the math, and as a quick aside, so Calgon is the biggest player in the United States, and they're owned by a Japanese chemical company, Kuraray. It's a $3 billion company in Japan. So, and there's a Nurit, which is a privately held company. So ADES is the only way, or one of the only ways, to play this massive catalyst of EPA policy change. The paper's it's already in the public domain, and it's in the public comment section process. And you have a 70 million market cap that has most of the cash that they need to get this thing to production. Now, and they brought in a CEO as an operator who just put up $2 million, and he's getting paid $50,000 in salary and taking his compensation at $3 strike price. So this is ridiculously asymmetrical. That's by far my biggest position. If they can pull it off, I think the stock goes materially higher. So I haven't even written on this. I'm still working on it with a couple of people. So I haven't been able to do all the calculations, but if people took the time to listen to it and you took the time to reach out, I'm sharing something that's kind of a rabbit in the hat.
We like it. We like it. Advanced Emission Solutions, ADES. You wrote about them in late June. So I guess that's kind of a prelude or an addendum, depending on how you're looking at it, to this conversation.
Yes.
Yeah. Appreciate it. Appreciate you sharing that with us. I have no doubt that listeners will appreciate a rabbit in a hat. The ones that do will. Courage and Conviction. Really enjoy talking to you. Really enjoy listening to you. Really enjoy this conversation. I hope it's the first. I hope you come back soon. And we're going to be reading your stuff in the meantime. I certainly will be.
Great. Thanks so much, Raina. I appreciate it. And thanks for thinking of me. Be well. Talk to you soon.
Just a reminder, anything you hear on this podcast should not be considered investment advice. This is for entertainment purposes only, and you should seek advice from a licensed professional before investing. If you enjoyed the episode, leave a rating or review on your favorite podcasting app, and we'll see you soon with a new episode.